Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And markets are again at new all-time highs, yet there are quite a bit of warning signals of exhaustion, of complacency. So we want to help investors better understand how do you position for markets that seem overextended, stretched, but continue to move here to the upside. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start with our normal market update, just to give you a sense for where the broader markets currently sit. We'll also take a look at some of the sectors that are currently rotating, where we see the stronger sectors moving higher here. We'll take a look at everything from rates and commodities, looking at how fixed income investors are currently positioning for this market, where the dollar is and what ramifications that has had on some of the commodities. Looking at economic indicators, we'll take a look at sentiment and housing, and then share with you a couple of ideas from the session here today. And then at the end, if we have a few minutes, we'll open this up for Q&A. But the primary question that I want to help investors answer that we've been receiving over the past few days has been largely around the fact that most investors feel that markets are overextended, they're overbought by momentum indicators, yet there's a high amount of complacency. And the question is really, how long can markets remain this stretched and complacent but continue to move higher? So those are some of the charts that I want to share with you today that we are looking at to inform our trading decisions. So we'll start off the S&P 500. And what we have here over the past few weeks is, as the markets continue to make a higher high in terms of price, those higher highs have not been confirmed by momentum indicators. And we're about to open up again to a new higher high after a long weekend. Equity markets globally yesterday were fairly strong, and momentum indicators so far have not confirmed that new high. So these are some of the concerns that investors continue to have. But the one thing I want to warn investors is that we've seen this before. We saw this during the November through February rally from last year of 2019 to 2020, right before the pandemic. We saw effectively what was almost a 2.5 month term, if you will, where markets continue to push to new highs, new higher price, was not confirmed by momentum, was very complacent, but continue to push higher here. So remember, markets can do this for a period of time. Many times investors, when they see markets are overbought, they see that complacency and they go out there and they short the markets and they buy puts. And many times that doesn't work out very well, because markets, again, can continue to be stretched for a long period of time. But a sell-off could materialize tomorrow. It could materialize, over almost any type of catalyst. That's almost impossible to predict. But based on the current market conditions that we see, our expectations in terms of a pullback are relatively minor. We're not expecting a 10, 20% correction in the markets. Now, that's not to say something like that can't materialize if new events come down the horizon in terms of that could drive that kind of catalyst, but we'll kind of have to see as those things materialize. But as of right now, the types of pullbacks that we're looking for are in the 3 to 5% zone. They happen far more often. They happen many times, about 10% of the time. In terms of markets, those are the ones that we're looking out for. And when we're trading at these all-time highs, use these opportunities to take profits on your long positions. Start lightening up your long positions. Start selling cover calls. Those are the types of strategies that you want to use as markets reach these overbought and complacent levels. And then if you need, as the markets, if they start to accelerate, you have a little bit of premium from those cover calls that you can utilize to fund buying some puts. So if we look at the QQQs, the NASDAQ 100 index, same thing. Push the new all-time highs, momentum no longer confirming those new highs. And as you can see, money flow is starting to get quite weak here on the daily chart. And this is if we continue to move higher here as we have opening up today here on the NASDAQ 100. What is interesting is that the one segment of the market that has been leading the market higher, which is small caps, is actually failing to open up today at new all-time highs, unlike the S&P and the NASDAQ. So this is really where we're starting to see a little bit of rotation here back into large cap, the NASDAQ 100, S&P 500, and a little bit of rotation out of small cap. I wouldn't quite say, one day makes a trend here. It's not enough to say that small caps are falling behind, but we are starting to see some of that here of large cap gaining ground here on small cap. And if we look at RSP, which is the equal weight S&P 500 index, also not making new all-time highs, at least not to the same margin as the market cap indices, which tells us there's a little bit of narrowness to the leadership, meaning fewer and fewer stocks in the big cap indices that are dragging the markets higher, while the broad-based index or the vast majority of the names within the S&P 500 not as strong here. So those are some of the things to look out for, because market tops tend to have narrow leadership. When you have broad leadership, that's usually a good sign of a healthy rally here. As you see more and more leadership, meaning the S&P 500 outperform the RSP, that's when we start to see the signs of a market top. But not just a single day, again, does not make a trend. But when we look at emerging markets, this is really where we see the outperformance when we look at global equities. Emerging markets, specifically EEM, which has mostly exposure to China, Taiwan, South Korea, has by far the strongest outperformance here. Now, if you look at the sector distribution of EEM and the geographic exposure that you get with EEM, substantially better looking than the U.S. domestic equities, which is why EEM continues to push to new all-time highs. But we also have the same problem. New all-time highs not confirmed by momentum. So starting to see signs of exhaustion, starting to send us some of these warning signals that these new all-time highs may not be as sustainable here. So those are some of the things to pay attention to. And then when we look within the U.S. domestic equity sector, when we have these types of complacent markets or markets reaching overbought levels, what we want to do is we want to identify sectors that are sectors that we're rotating into. We want to identify which sectors are we rotating out of and which sectors are we rotating into. The first one I want to pay attention to is XLF. XLF is starting to break out above a major resistance level. This is the resistance level from the February 2020 highs. We've also formed a bit of a double top here over the past few weeks, and we're just opening up higher above that level here. So XLF, seeing a strong rotation into XLF. And when we take a look at the yield curve in a little bit, it'll explain why we're seeing such strength here from XLF. It's really just a combination of strong recovery from an economics perspective and higher yields on the treasuries, higher yield in the steepening rate curve. That provides support here for XLF. And for those of you following the news, we're also seeing quite a bit of movement here from nat gas, from gasoline, from just oil in general. Big move as Dallas and Texas is going through a bit of a deep freeze, really constraining supply here in terms of petroleum here or crude here in the United States. This has provided a boost to natural gas prices, the gasoline prices, the energy prices, electricity prices. And what we've seen here is a very similar setup here in XLE. XLE also breaking out above this all-time high here around, this double top here at around $45, breaking out higher here. So XLE, again, getting another short-term boost here from the news cycle, if you will, to the breakout here. So XLE remains one of the strongest sectors here in the U.S. equities. Now, when we look at U.S. equities, we see some weakness here from discretionary. We see some weakness from utilities and real estate, especially as yields start to climb. These higher yielding sectors are starting to see seeing some rotation out of those sectors. So it's important that when you're positioning for this type of market, you understand which sectors are strengthening, which sectors are weakening, because the weakening sectors are the ones that you want to avoid. The strengthening sectors are the ones that you want to pay attention to. Now, taking a look at markets, the equity markets, VIX 3M versus VIX, front month VIX, so the 3-month VIX, the 90-day VIX versus the 30-day VIX, we continue to see this remain at fairly elevated levels right now, 1.26. That's fairly complacent. Anything above 1.2, 1.25, we consider complacent. That's where the market is at risk of a short-term pullback here. That's exactly the level that we're at right now. If it's below 1, those are buying opportunities, or rather, below 1 is when markets are stretched or when markets are fearful. We're nowhere near there, even though we were just there a couple of weeks ago when markets looked like they were starting to break down, but quickly came back above those levels. And then just within a few days, a couple of weeks later, we're back at complacent levels again here. So this is really something to pay attention to and be aware of, is that level of complacency that we continue to see in the markets, especially if you look at put-call ratios continuing to remain at very, very complacent levels. Those are some of the concerns that equity investors continue to have. When we switch our attention here to fixed income, treasuries continue to climb here. 10-year yields climbing above that 115 level, which was a major resistance level for a few weeks, climbing now up to the 125 level. This really starts to put 150 into the targets for 10-year yields. At the beginning of the year, we're looking for about 100 basis points. But as the economic recovery continues to take shape, we continue to see 10-year yields climb here. Climbing towards that 150 level certainly would be an interesting play here, especially for financials. We've seen a big move to the upside from financials as a result of the climb in rates and the steepening of the rate curve here. So this continues to provide a fundamental reason for why we still believe XLF has further room here to the upside. When we look at the dollar here, we started talking about the dollar potentially bottoming here, putting in what looked like an inverted head and shoulders. And we even got a couple of days where it started to break the neckline of that inverted head and shoulders and looked like this was starting to reverse higher here. But we've seen so far that that is not the case. This is more likely going to look like a continuation pattern lower rather than a reversal pattern higher here. So looking at more just like a consolidation zone after what was a strong sell-off, you consolidate for a period of time and it resolves itself here to the downside. We did have a similar play here before where you had what looked like an inverted head and shoulders. This was after a pretty massive move to the downside. And just like that before, had a couple of day move above the neckline and then continue back lower here. And that's exactly what I think we're going to see here again today. For the dollar going forward here over the next few weeks is likely something that looks like this. So dollar is continuing to weaken here, and this has ramifications for commodities. This has ramifications for gold. We continue to see copper climb to new all-time highs, emerging markets climb to new all-time highs. This is all tied to the dollar. This is all tied to rates continuing to climb. So if we look at treasury yields, treasuries continue to this strong downtrend that we see here. This is TLT breaking down to new lows since the pandemic, actually breaking below some major significantly support resistance levels here that we have had from pre-pandemic levels. Breaking below these levels, this certainly points to potentially even 136 to the downside here for TLT. So fixed income investors are selling safer fixed income products like treasuries, and what they're doing is they're buying riskier fixed income products like HYG. This is becoming a fairly crowded trade, I would say, and there is some risk in this type of crowding, if you will, of investors crowding into higher risking, higher yielding, and higher risk fixed income products, because when things turn south, if things turn south, everyone tends head towards the head towards the exits at the same time. This creates a bit of a liquidity trap here. So, when we have these crowded trades, those are also another warning signal. Just because it's crowded doesn't mean you should go out there and short these markets or anything like that, but these are warning signals to pay attention to. When people say, 2008 came out of nowhere, or 1999 dot-com crash came out of nowhere, there were warning signals, and these are some of those warning signals. That doesn't mean that it's going to result in the same type of magnitude as 2008 or 1999, but some of these warning signals were available, and we're seeing some of them start to fire off here right now. As I said, when we look at the dollar declining, this has ramifications for a lot of commodities. Copper is one of them, palladium, platinum, all of these names, all of these dollar-denominated commodities are starting to see continued move here to the upside. Commodities breaking here to the upside. For those of you trading some of the commodity miners like FCX, you're going to see continuation higher on some of those names here. But copper breaking out above that double top here around 368 or so, targeting now $4 here to the upside. We haven't seen $4 since about 2011 on copper. So copper continuing to move here to the upside, Bitcoin continuing to move to the upside. Anything denominated in dollars, we're starting to see continued move here to the upside. So switching over to take a look at economics, sentiment indicators actually coming in a little weaker than expected. And if you look at some of the underlying numbers behind the sentiment, it does make some sense. So survey was about 80%. We were expecting just more about moderation here in terms of consumer sentiment, but actually declining a bit here, 76.2. This really came down to some of consumers' expectations of future financial stability was starting to weaken a little, especially around housing, especially around being able to purchase vehicles. Durable orders, those types of things came in a little weaker than expected. Mortgage applications continue to start off 2021 in extremely strong, even stronger than 2020 right now, or even stronger than the end of 2020. Mortgage applications continue to be extremely strong, and inventory levels remain all-time lows. So this provides a distortion here in the housing markets that we have continued to see towards the end of 2020 extend into 2021, where consumers want to buy houses, but inventories are extremely low. This is good for some of the home builders, some of the home construction ETFs, lumber. Those types of segments of the markets are at this point being rewarded, if you will, on the back of this type of housing, I would say, scenario that we have created here as a result of the pandemic. So looking at some of the ideas that we have here for today, FedEx, we've been looking at FedEx for quite some time. We actually pulled the trigger on a FedEx trade here, but that failed. But looking at it now, it looks a little bit more stable in terms of FedEx. So FedEx has had a very strong run to the upside. It pulled back to the 21-week moving average. It couldn't hold that level just at the time that we were looking at it, but now it's managed to break finally back above the 21-week moving average, which would certainly suggest that we've had a bit of a pullback here, and we're going to continue potentially moving higher here. And we zoom in here on the daily chart here. So this is, for example, some negative divergence that resolved itself, a big negative divergence resolving itself here. And then what we started to have here is a bit of positive divergence. When price made a lower low, momentum did not confirm that lower low and is now starting to trend higher here. So you have a bottoming formation here where the 21-day moving average has acted as resistance, is now providing support. We've broken above that resistance level, come back to retest that level as support, and is now starting to move higher here. So FedEx completing what looks like a small bottoming formation here and starting to move higher here. The risk-reward ratio here on FedEx looks fairly strong here. You have a target upside to around $300 from 263 or so. So you have roughly about $35 of upside here. And I would say that if it gets back below the 21-day moving average, which is around 250 or so, I would consider cutting my losses. So you're looking about $13 of risk to the downside with about $35 of upside in terms of targets here to the upside. So the risk-reward ratio here on FedEx, I think, looks fairly attractive. and we've been talking about financials and the strength of financials here, JPM really remains best of breed here of the major banks, and the price action for it confirms it. It is by far one of the few major banks that is near all-time highs, and as of this morning is about to open to a new all-time high above its February, January all-time highs here around 140 or so. You have a double top that's formed here over the past couple of weeks. We've now broken above that double top here, so that is again a possible, especially as we're seeing a lot of strength here from financials, some rotation into some of the strong names here like JPM. And then just to show you some of the opposite side of this, right? Because as we are approaching these complacent levels, if you're looking for some opportunities on the short side, you want to look at sectors that are lagging behind. Consumer discretionary starting to see quite a bit of decline here, because as equity markets reach new all-time highs, you see a lot of discretionary names start to diverge from that move in equities to all-time highs. The discretionary as a sector is lagging behind, and then you have some names like Ross Stores that are starting to decline here to the downside. Failing to reach new all-time highs are now starting to sell off here as equity markets reach all-time highs. That's the type of weakness that if you're looking for shorting opportunities, you want to keep an eye out for. So Ross Stores, for example, is an example of one of those names where you have a discretionary name lagging behind the sector, which is lagging behind the broader market. So that's how you want to go about thinking if you are looking for some short opportunities in this market using those types of strategies. And I always encourage investors, if you're looking for bearish opportunities, to use limited risk strategies, using options to allow you to play for downside with limited risk, because we have all seen GameStop, we have seen BlackBerry, we have seen those types of stocks take some big moves to the upside. If you short the stock itself, you are exposing yourself to unlimited losses. If you buy a put, if you buy a put spread, or if you sell a call spread, a call credit spread, these are all opportunities that you can take a bearish view or even a neutral view in an underlying stock like Ross Stores, but do so in a way with limited risk. And that helps protect you against the unknown, if you will, of potentially a stock that you're shorting or a stock that you have a bearish view, being a target of one of these Reddit forums or things like that, and taking on unlimited losses. You don't want to expose yourself to that. So this is an example of a stock, but also more importantly, a lesson to learn when you're thinking about a bearish position, to utilize a limited risk strategy such as options. So with that covers what I wanted to share with you here this morning. I hope that this helps you set up your trading day with a better understanding as to where we are currently sit within the cycle. How do you want to position yourself, and how do you want to think about the type of complacency that we're seeing here in those markets, and just generally speaking, how you want to navigate that. So with that, thank you so much. I hope that you guys have a great trading day, and I'll see you guys here next week. Have a great day.